I will go ahead and get started with the second quarter market review. Here's the agenda for today. We're going to be looking at, like we always do, the market in review. Then we will look specifically at equities versus fixed income, take a look at the global outlook, a lot of talk and concern about elections and market returns, and then the importance of staying diversified. So we always look at the economic indicator dashboard when we are doing this quarterly market review, and you can see that for the first time in a while, market volatility is outside of the typical range. And that is moving back towards typical since the bottom on March 23rd. The U.S. Treasury yield went from almost 2% earlier in the year down to about 0.5%. Currently, yield spreads are decreasing. Home prices are continuing to increase. We have low inflation, very high unemployment. Economic expansion is off the charts just because of the forced pandemic. And consumer sentiment is continuing to stay within normal limits. So not a big surprise there. This looks at the capital markets in the period ending June 30th, and you can see that second quarter was good. I'll cover that in a little bit more detail in the next slide. If we look at the one-year trailing, including the big downturn in in March, when the pandemic first started, you can see that almost everything was negative over a one-year time period. The returns on U.S. equities and U.S. bonds were both in positive territory for the year. So let's look at what worked and what didn't during this time period. This exhibit provides context on how different parts of a diversified portfolio performed during the second quarter, and the results were positive across the board. But as you can see, the big winners were U.S. small cap being up 25+%, and U.S. large cap being up almost 22%. Emerging markets, non-U.S. equity, green is a balanced portfolio, so people weren't pulled down as much that didn't have 100% equities, but they also had a nice bounce back during that time period. So this really looks at the wild ride that happened for investors from January 1st to February 19th, and then the very quick and dramatic drop. Despite gaining 5% to start the year, the S&P quickly and unexpectedly dropped over 30% over fears of the corona epidemic, and it was the fastest 30% decline in history. I've been in this business 30 years and never seen anything drop so quickly or come back so quickly. Actually, this is the best quarter is the best quarter since the fourth quarter of 1998, pre-tech bubble. So although the S&P remains below the starting point for the year, investors who stayed invested during the market volatility have recovered most of their losses from the market's deep declines. And this is just this dramatic drop and subsequent rally are a great example of the importance of sticking to a plan instead of trying to time the market, reacting to short-term movements. I don't think anybody expected it to come back this quickly, and with the election coming up, that we may continue seeing volatility, but Moving on to page 8, slide 8. This one's titled Concentration of the S&P 500 Exceeds the Late 90s. This is interesting. Some of the largest names in the S&P have experienced some of the best recent performance that has led them to making up a much larger component of the overall index allocation. As you can see on this slide, at the end of the second quarter, the top 5 components of the S&P now make up over 20% of the index. To put that into perspective, if we look at the top 50 of the S&P 500, they return positive 2.9 for the year, while the broad S&P was down 3.1. And if we look at an equally weighted index of all 500 companies rather than by the values of the company themselves, then the equally weighted index is down almost 11% for the year. So the question always comes up in a diversified portfolio: if the S&P is up this much, why isn't my portfolio? And it's because we do globally diversified and cover growth and value in small, medium, and large. So I think that this is an important point to make. And as you're looking at this slide, if you're not aware what Alphabet is, Google changed their name of their holding company a few years ago to Alphabet, and they have a Class A and a Class C. Some are voting and some are non-voting rights. So I just thought I would clear that up here. And you can see on the right that there are industrials, energy, financials were hit really hard this year to date. Now, the next thing we're going to look at is the growth versus value. And that is growth stocks have continued their outperformance relative to value in the second quarter of 2020, with the Russell 1000 growth index being up 27.8% and Russell value only returning 14.3%. Both of those are, are good returns, but despite the strong outperformance by growth versus value, many conditions that are present today have historically been more favorable to value over growth. This includes falling high yield spreads on bonds following a trough in the business cycle, and increased government spending that we will cover a little bit later in the slides. So if we move to the next slide, leading companies can hit rough patches. When investors see what seems like never-ending leading market returns from headline companies, it seems they may be immune from pullbacks or that they will always outperform. Looking at the list of firms here, it helps make the case for diversification. Dominant firms rarely, if ever, stay dominant. And you can look at what happened to Google. Bank of America in the global financial crisis was down 94%. Coca-Cola, a company that people always consider to be stable because people are always going to drink Coke. AT&T, phones, Cisco Systems that are technology, down 60, 73% over that time period. In previous tech bubble, again, surprisingly that JP Morgan would be down, Disney, McDonald's, companies that you often hear are immune. So Apple during the tech bubble was down 81%. So I just want to, when people start thinking that they should run to concentrating in what's done best, the downside can be much more detrimental. So a diversified portfolio can help mitigate some of this risk. Now, looking at the global equity market rotation, I know people have heard this from me, and even though the past several years have been dominated by the U.S., we've seen this many times historically, and the non-U.S. markets are maybe poised to take leadership. I think some of the points I want to make here are that it's been a long stretch, a long, strong stretch for U.S. stocks over the last 10 years. Historically, after a strong stretch, the leading market tends to cede leadership to another area. We don't know what that will be next, perhaps international or emerging markets. Non-U.S. markets have some favorable tailwinds at their back, which could help non-U.S. stocks take the lead sometime during the next 5 years. So I wouldn't write them off, and I wouldn't completely get rid of them out of the portfolio. This slide is titled "Why Underweight Treasuries?" Market dislocations that, like we've seen today, create active management opportunities for bonds, just like they can in the stock market. And this shows the excess return over treasuries. And you can look in 2019, if we look at U.S. investment grade, you earned over 6% more, and U.S. high yield over 9% more during that calendar year over treasuries, and emerging market debt, the same thing. You can see where you have the opportunities for a greater spread. You also have the downside opportunity as well. U.S. high yield, we're down 17%. Anytime the U.S. stock market drops dramatically, you tend to see a drop in high yield and investment grade, just because of the unknown strength of the companies. Are they going to be able to service their debt? But as you can see in Q2, all three of those asset classes jumped back nicely. So they moved towards more traditional relationships, as that slide says. So another big concern for people is how are state and local governments going to fare through this crisis? And as this says, learning from the global financial crisis, every state has some type of rainy day fund with varying deposit and withdrawal rules. So a lot of municipalities have been growing these rainy day balances post 2007 to 2009. So they're in a better position to mitigate a portion of those tax losses that are likely to have shortfalls as a result of the COVID-19 sell-off. It doesn't guarantee that states and local governments are prepared to cover shortfalls over a long time period. And we don't know the long-lasting effects of COVID-19. So one area to note is each municipality has different finances. So using an active management approach to uncover opportunities, we feel is prudent rather than owning an index in this area. If you're going to invest in municipalities, you want somebody overseeing and picking good risks in that area. And we have plenty of opportunities with the money managers that we use. The next slide, slide 14, titled "A Flight to Cash." During the market volatility experienced in the first quarter of this year, money market funds received their largest inflow in history, bringing in $685 billion of assets in March of 2020. For comparison, this amount was nearly double the inflows during Q4 of 2008 during the peak of the global financial crisis. and larger than the entire calendar year of 2019. So the inflows continued for April and May, resulting in there's $4.8 trillion in money market funds during April and May, and that is $1 trillion more than the previous peak in January of 2009. So markets have started to rebound after those record lows in March, and this just highlights the difficulty of trying to time the market. So people that jumped to get out in March that, felt they saw this coming, pulled out at a bottom and missed a very short opportunity for pullback. So it can be frugal to take out some just in case, but people that want to go 100% to cash, that can be a really difficult call to make. So we only have about 5 or 6 slides left. This is, Russell provides us with this economic outlook. So we always take a look at their global market outlook, but I like to give that caveat that this is Russell's view on what the market outlook is and what their key expectations are. So fiscal stimulus in the U.S., the packages that have passed since March provide the nation's economy with its most significant fiscal thrust since World War II. With the potential for more stimulus on the way, we are positive on the U.S. economic outlook. That's Russell. Their forecast is the Organization for Economic Cooperation and Development forecasts a 9.1% decline in the Eurozone GDP for this year, followed by a 6.5% rebound in 2021. In the UK, they predict 11.5% decrease in GDP, followed in 2020, followed by a 9% rebound in 2021. As far as geopolitical risks go, while they are rising between the U.S. and China, Russell doesn't believe the increased rhetoric will lead to a dissolution of the Phase 1 trade deal that was signed earlier this year. China appears well positioned for a strong rebound through the second half of 2020 and on through 2021 as the economic stimulus in the global economy recovers. And they believe overall that the recovery from the recession will lead to a long period of low inflationary growth supported by monetary and fiscal stimulus. Whoops, I went the wrong way. This shows that the stimulus during the global financial crisis from G2 countries was $2 trillion. Today, 10.7 trillion. Back then, that was back in the global financial crisis, that was approximately 3% of the global GDP. Committed capital today represents 12.1% of the global GDP. That scares people, and we get asked a lot about servicing the federal debt. Given the high levels of U.S. government spending due to the economic impact of COVID-19, people are concerned about this level of debt, which is understandable. But while the debt level is an issue that precedes the current fiscal stimulus, this historic low interest rate makes servicing the debt much more manageable. In fact, heading into 2020, the total federal interest expense as a percent of GDP was very much in line with the historical percentage of just above 1.5%. And the Federal Reserve has been vocal about their desire to try to influence interest rate to be lower for longer. The public debt as a percentage of GDP is above 100%, but again, because of the low interest rates, the actual interest expense to maintain the debt is not too burdensome. That's a hard word to say, on the overall economy when you view it historically. The debt level is something that's going to have to be addressed at some point, but that's a statement that has been made for decades. At least they're not taking on this kind of debt when interest rates are in the 4, 5, 6, 7% rate. So that leads to the next question: who is going to pay for federal stimulus? Well, go take a look in the mirror. It's individual taxpayers like you and me that are the primary contributors to federal revenue. According to the data from the Tax Foundation, individual taxpayers represent, as shown in this slide here, 41% of all federal tax revenue. Individual taxpayers are the single largest contributor to the federal coffers. To support the federal debt, the government's going to continue to look at individuals like us, all of us on the call, to support the spending. Many other developed countries lean on corporations and consumption taxes, like VATs that they have in Europe and in Canada. In the USA, individuals get the opportunity to pay more. Although a value-added tax is a consumption tax that's paid by individuals as well, so that's not that different. So anyways, will we see increase in dividends and capital gain tax rates in the future? Likely. Now, the next concern that has been a result of the pandemic is the dramatic and swift change in employment. Due to the mandatory economic closures and stay-at-home orders that were enacted to slow the spread of COVID-19, the U.S. economy shed over 22 million jobs in a little over 3 months. Since the bottom in April, economic restrictions that have been lifted and jobs that have bounced back strongly have added about 2.7 and 4.8 million jobs in May and June. Not quite, a little bit over a third of what's been lost. So we do have a long way to go. The graph here depicts the different rates at which jobs would need to recover in order to get back to the historical highs that were reached in January of 2020, when we had the lowest unemployment rate in many, many years. So if you look at the different color lines, the gray line represents the path back to peak unemployment, assuming the economy adds the same amount of jobs as it did on the last job report, 4.8 million a month. The light blue line assumes the economy adds jobs at the highest rate over the last 10 years. So that would be about 250,000 per month. The red line assumes the economy adds jobs at the rate of the average over the last 10 years, 185,000 a month. The yellow line assumes the economy adds jobs at the lowest rate in the last 10 years, as seen in 2007 at 86,000 a month. So it should be noted that a job loss based on education level has also not been impacted equally. In April, workers with less than a high school diploma saw unemployment rates spike 21.2% from a low of 5.4%. And at the time, the national average was closer to 15%. People that had a bachelor's degree or higher only had 8% unemployment rate. So there's that's just taking a look under the numbers. And then here's the big thing that people talk about all the time: what is going to happen if Trump stays in, if there is a change in leadership. And basically Russell sliced and diced this in many different ways. And with the upcoming election, you know, people want to know the impact that the election will have on capital market returns. So Russell looked at the calendar year U.S. stock returns based on the S&P 500 through just about every combination and permutation that we could determine. The data presented shows which party is in control of the presidency, the U.S. Senate, and the U.S. House of Representatives, and they went all the way back to 1945 in World War II as the starting date. And when you look at this, you'd be hard pressed to make a definitive case that one combination is better than the other. The data is presented here likely has something for everybody depicting Republican or Democratic leadership, which looks more appealing. I show a slide like this every time we have an election year because people are convinced that things are going to fall apart one way or the other, and historically that just has not been the case. The other thing that need to be taken into consideration in conjunction with the political powers or political parties that are in power are where were we in the economic cycle? Were we in a period of expansion or recession? What was the Federal Reserve's interest rate policy? Think about where Paul Volcker was back in the 70s and 80s. What foreign events were impacting the global markets? Think of oil embargoes, trade conflicts, the fall of the Berlin Wall, etc. What technological changes or disruptions occurred in the U.S. economy? Think about what happened with the internet. So there is much more to capital market returns than just what the political party is coming into office. And the one thing that I do want to mention here is that when you look at this minus 17%, I don't want you to read too much into this slide with a negative return of 17% for a Republican president, Democratic Senate, and a Republican House. It's only occurred 2 times in 2001 and 2002 and reflects the market's reaction to 9/11, which happened in 2001, and the related recessionary impacts that occurred after what happened with Enron and the accounting crisis and frauds that occurred back in 2002. So where does the market go from here? You look here and see that uncertainty about the economy and the markets has created a wide range of expectations from investors. The range is fairly evenly split among all of these different scenarios, but there's support for good and difficult results. As you see here, reasons for optimism: the governments are supportive around the world, lockdowns are starting to lift, job losses are slowing, but there are reasons for cautions. Markets are no longer inexpensive, at least in the US. There is and will continue to be concerns over the virus, and we have record levels of unemployment. So, it's not all roses. Everything isn't coming up roses, as they say. So I'm going to wrap this up with the last 2 slides here: weighing uncertainty versus long-term results, and why it's so important to look at being diversified over a long time period. When you look at this slide here, it's showing the percentage of periods that produced positive returns from 1970 through 2020. There was a 75% in a quarter that you would have positive returns, only a 1 in 4% chance you'd have a negative quarter. When you go out to 1 year, 86% chance of a balanced portfolio being positive. You go out to 3 years and 5 years, you have a 92% probability, and longer term, 10 to 20 years in a balanced portfolio, 100% probability that you would have a positive outcome. So capital markets have rewarded long-term investors over most time periods, and this should be a reminder that not being 100% invested in any one market area, it may look good in those years that things are going great, but one steep downfall can have a very negative impact that can take much, much longer to get back from than owning a diversified portfolio that overweights to stock and owns bonds to protect on the downside. So with that, I am going to wrap up today's second quarter outlook. If you have any questions at all, feel free to reach out to me at Kathy@fishandassociates.com with any questions. You can call our office at 901-767-0668. We'd be happy to answer any questions there as well. Thank you all so much for your participation today. I hope the information was useful, and we will be back again in 3 months after the end of the third quarter. Thank you for taking the time out to listen in today, and I hope you have a great rest of your day and week. Thank you.